Welcome back, everyone. Today we're talking about something you interact with all the time, whether you realize it or not: corporations. I'm Dr. Wendy Tietz.
And I'm Professor Jill Mitchell. From big names like Apple to smaller businesses on your main street, corporations are everywhere and shape so much of our economy. So, Dr. Teets, what sets corporation apart from other types of businesses?
Excellent place to start, Professor Mitchell. One of the most defining traits is that a corporation is a separate legal entity. Essentially, it's like a person legally. It can own property, enter contracts, and be sued. And here's the key part: the corporation's assets and liabilities belong to the company itself, not to individual shareholders.
Right. And since it's its own legal entity, corporations also benefit from continuous life. This means that if one shareholder sells their stock or passes away, the corporation keeps on going. That's a big contrast to sole proprietorships and partnerships, where the business often dissolves if ownership changes.
It's a big advantage, especially for stability. Investors and employees don't want to have to worry about the business closing unexpectedly if an owner decides to leave. They know the company will continue, which is a big advantage to that corporate form of business over the sole proprietorship or partnership form of organization. Investors like that continuity of life.
Absolutely. And speaking of appealing to investors, corporations offer limited liability. Shareholders are only on the hook for what they've invested in the corporation. So if a corporation faces financial trouble, the personal assets of the shareholders are safe.
That's a huge incentive, especially for larger investments. Imagine being able to invest in big projects without risking your house or other personal assets. This feature alone attracts people who might not otherwise invest in business ventures.
True, but with that great structure comes some challenges. Corporations have separation of ownership and management. The shareholders or owners are separate from the managers who make daily business decisions. Sometimes this can lead to conflicts if managers focus more on personal gain than on what's best for shareholders.
That's why corporate governance is so important. Good governance practices, like having independent board members and regular audits, can help keep everyone accountable. Otherwise, you could end up with situations where managers run things for their benefit instead of maximizing shareholder value.
Exactly. And here's another consideration: corporate taxation. Corporations pay taxes on their profits. And then when they distribute those profits as dividends, shareholders are taxed again on that income. It's what's called double taxation.
Double taxation is a price corporations pay for that legal separation from their owners.
True. And then there's government regulation. Corporations are under more scrutiny because they offer limited liability to shareholders. This means they have to be transparent with their financial information so investors and creditors can make informed decisions.
Right. Accounting plays a crucial role in all of this, providing reliable information that others use to make major financial decisions. That's a big reason why corporate financial statements have to meet certain standards, such as generally accepted accounting principles or GAAP.
All right, Dr. Teets, let's do a quick recap. Corporations are separate legal entities with continuous life. There's limited liability for shareholders, and there is separation of ownership and management. But corporations also face double taxation and are heavily regulated.
And now that brings us to how corporations raise funds by issuing common stock. When a corporation decides to sell ownership shares to the public, it can raise huge amounts of capital, which is why so many companies go this route.
Right. And when they issue stock, they often set a par value, which is a nominal amount assigned to each share in the corporate charter. Most companies set their par values low and then sell shares at a much higher price. The difference goes into an account called capital in excess of par.
So let's take a look at a recent example to illustrate this. Reddit's initial public offering, or IPO as it is commonly known as. Reddit is a popular social media platform often called the front page of the internet because it's filled with community driven content. Users join specific interest groups called subreddits to discuss everything from current events to niche hobbies. On March 21st, 2024, Reddit offered 22 million shares of its common stock at $34 each, raising about $748 million. The par value for Reddit's share was only 0.0001 cent per share, so the rest of the share price went to Reddit's capital in excess of par account.
This was a significant milestone for Reddit. Not only did they raise a large amount of capital, but they also became accountable to public shareholders who will want updates and solid returns on their investment. And as a public company, they now have a lot more transparency obligations.
Exactly. IPOs are a huge step for companies because they open up many growth possibilities. But it's also a transition to a new phase where decisions need to be more transparent with every major step documented and accessible to shareholders.
And once shares are issued, they're bought and sold on the open market. These secondary transactions don't involve the company directly, but the stock's performance on the market can greatly impact how the company is perceived.
Absolutely. Stock prices can affect investor confidence and even employee morale if they own shares. It's fascinating how the market can reflect so much about a company's current and future prospects.
Issuing stock, especially in an IPO, is one of the most powerful ways for corporations to raise capital, and it benefits stockholders too. If the company performs well, their stock's value often goes up, so it's a win-win.
And it gives companies a path to fund growth without accumulating debt, which can keep their financial structure more balanced. That is why you often see large tech companies or growth stage firms going public. They need capital, but they also want to keep their liabilities manageable.
Exactly. So, to sum it all up, issuing stock is a pivotal step in a corporation's growth, and it's a huge benefit of the corporate structure that's not typically available to other types of businesses.
Okay, that's a wrap, everyone. Today we've covered what makes a corporation tick, from the features that make it unique to how stock issuance fits in. Thanks for tuning in.
And keep those questions coming. Join us next time for more insights into accounting and business concepts. Until then, always be a work in progress.